Have you ever noticed how the market always seems to know where your stop loss is? You place your trade price sweeps just enough to knock you out, and then it takes off in the direction you expected. That's not an accident, that's liquidity. In this video, we're going to master liquidity like a pro. You'll discover what it really means, where it hides on your charts, and how smart money uses it to move the market. And by the time we're done, you'll understand how to stop being the liquidity and start trading with it. Before we dive deep, make sure you subscribe to the channel and hit the notification bell so you never miss more trading insights like this. What is liquidity? At its core, liquidity is the fuel of the market. It's what allows price to move from one level to another. Think of it as pools of money sitting in the charts waiting to be tapped. These pools exist because traders all around the world are placing stop losses and pending orders in predictable places. Above the highs, there are buy stops, traders betting on breakouts or protecting shorts. Below the lows, there are sell stops, long traders trying to protect their positions or breakout sellers waiting to enter. Those stops are liquidity. They are the orders that big institutions need in order to move large amounts of money. The market cannot function without it. Buy side and sell side liquidity. Now let's bring this into focus. When liquidity builds above a high, we call that buy side liquidity. When it builds below a low, that's sell side liquidity. The market is always hunting these pools. Why? Because when price takes out those highs or lows, it unlocks a fresh stream of orders. That's what allows institutions to either reverse the market or push it into the next phase of movement. So whenever you see a clean swing high or swing low on your chart, understand this. It's not just a random level, it's a magnet, a pool of liquidity waiting to be raided. The most important liquidity pools, but not all liquidity is equal. Some levels carry far more weight than others. For example, the previous month's high or low is a massive liquidity pool. Institutions know that traders across the world are watching these levels, placing stops around them and waiting for a breakout. The same applies to the previous week's high or low and the previous day's high or low. Even the most recent session high or low attracts orders. And don't forget old swing points or equal highs and lows. Anytime you see price rejecting a level multiple times, that's a clear signal. Liquidity is building just beyond it. If you start marking these levels on your chart, you'll notice something powerful. Price almost always gravitates to them before making its next significant move. External versus internal liquidity. Now let's take it deeper. When liquidity sits outside the boundaries of the current dealing range, we call that external liquidity. Picture the very highest high or lowest low on your chart. Beyond those extremes lies a cluster of stops and breakout orders. Institutions love to drive price into those external zones, trigger the orders, and then reverse the market in the opposite direction. On the other hand, there's also internal liquidity, the liquidity that builds inside the range. These are the short-term highs and lows inside consolidation, the tiny swing points that traders use for stops. Price often uses this internal liquidity as stepping stones before reaching for the external pools. Liquidity sweeps the stop hunt, and this is where it all comes together, the liquidity sweep. Here's the classic story you've probably experienced. Price creeps up toward a clear high. Traders pile in, breakout buyers, and short sellers have stops sitting above. Price pushes through that level, triggers all those orders, and then suddenly it snaps back in the opposite direction with speed. The same thing happens below lows. Long traders get stopped out, breakout sellers pile in, and just like that, the market reverses. This is not manipulation, it's simply how the market is designed to work. Price must reach for liquidity first before it can move where it truly wants to go. How to trade liquidity like a pro. So how do you turn this knowledge into an edge? It's simple. Don't chase the move, wait for the sweep. If buy-side liquidity gets taken, meaning a high has been cleared, watch closely. If the market rejects that level and shows displacement to the downside, you have a high probability short setup, aiming for the next pool of sell-side liquidity below. If sell-side liquidity is swept, meaning a low is taken, and the market snaps back up with strength, you got a potential long with your target set on the buy-side liquidity above. This is how you stop being the trader who gets hunted and start trading alongside the smart money. Liquidity is the heartbeat of the market. It's the hidden force behind every stop hunt, every reversal, and every expansion of price. If you can train your eyes to see where liquidity is resting and learn to anticipate the sweep before the real move, you'll step into a new level of trading mastery. I hope this video gave you clarity and insight into the true nature of liquidity. If you enjoyed it and you want to keep learning how to think and trade like the smart money, make sure you subscribe to the channel right now and turn on notifications so you don't miss the next upload. Thanks for watching, and remember, the market always seeks liquidity first.